Greetings and welcome back to the channel. Andrew May here, investment advisor and certified financial planner professional, bringing you more real-world strategies designed to assist you in navigating your personal financial life. In today's video, I'd like to share an article with you that I found online titled 3 Mistakes Investors Make During Election Years. It was written by Rob Lovelace, equity portfolio manager, and Daryl Spence, economist, both with Capital Group. This is one of the world's largest investment management firms with $1.7 trillion under management according to their website. The article states that investing during an election year can be tough on the nerves, and 2020 promises to be no different. Politics can bring out strong emotions and biases, but investors would be wise to put these aside when making investment decisions. Below, we highlight 3 common mistakes made by investors in election years and offer ways to avoid these pitfalls and invest with confidence in 2020. Mistake number 1. Investors worry too much about which party wins the election. There's nothing wrong with wanting your candidate to win, but investors can run into trouble when they place too much importance on election results. That's because elections have, historically speaking, made essentially no difference when it comes to long-term investment returns. Presidents get far too much credit and far too much blame for the health of the U.S. economy and the state of the financial markets, says Capital Group economist Daryl Spence. There are many other variables that determine economic growth and market returns, and frankly, presidents have very little influence over them. What should matter more to investors is staying invested. Although past results are not predictive of future returns, a $1,000 investment in the S&P 500 made when Franklin D. Roosevelt took office would have been worth over $14 million today. During this time, there have been exactly 7 Democratic and 7 Republican presidents. Getting out of the market to avoid a certain party or a candidate in office could have severely detracted from an investor's long-term returns. By design, elections have clear winners and losers, but the real winners were investors who avoided the temptation to base their decisions around election results and stayed invested for the long haul. Mistake number 2. Investors get spooked by primary season volatility. Markets hate uncertainty, and what's more uncertain than primary season of an election year? With so many candidates on the campaign trail, 11 Democrats were still running when primaries kicked off in early February, the range of outcomes can feel daunting. But volatility caused by this uncertainty is often short-lived. After the primaries are over and each party has selected its candidate, markets have tended to return to their normal upward trajectory. Mistake number 3. Investors try to time the markets around politics. If you're nervous about the markets in 2020, you're not alone. Presidential candidates often draw attention to the country's problems, and campaigns regularly amplify negative messages. So maybe it should be no surprise that investors have tended to be more conservative with their portfolios ahead of elections. Since 1992, investors have poured assets into money market funds, traditionally one of the lowest risk investment vehicles, much more often leading up to elections. By contrast, equity funds have seen the highest net inflows in the year immediately after an election. This suggests that investors may prefer to minimize risk during election years and wait until after uncertainty has subsided to revisit riskier assets like stocks. But market timing is rarely a winning long-term investment strategy, and it can pose a major problem for portfolio returns. To verify this, we analyzed investment returns over the last 22 election cycles to compare 3 hypothetical investment approaches: being fully invested in equities, making monthly contributions to equities, or staying in cash until after the election. We then calculated the portfolio returns after each cycle, assuming a 4-year holding period. The hypothetical investor who stayed in cash until after the election had the worst outcome of the 3 portfolios in 16 of 22 periods. Meanwhile, investors who were fully invested or made monthly contributions during election years came out on top. These investors had higher average portfolio balances over the full period and more often outpaced the investor who stayed on the sidelines longer. Sticking with a sound long-term investment plan based on individual investment objectives is usually the best course of action. Whether the strategy is to be fully invested throughout the year or to consistently invest through a vehicle such as a 401k plan, the bottom line is that investors should avoid market timing around politics. As is often the case with investing, the key is to put aside short-term noise and focus on long-term goals. How can investors avoid these mistakes? Don't allow election predictions and outcomes to influence investment decisions. History shows that election results have very little impact on long-term returns. Expect volatility, especially during primary season, but don't fear it. View it as a potential opportunity and stick to a long-term investment strategy instead of trying to time markets around elections. Investors who were fully invested or made regular monthly investments did better than those who stayed in cash in election years. I hope that you found today's article insightful and thought-provoking, and I will include a link to the article in the description section below. If you found today's video informative, then be sure to hit the like button and subscribe to the channel. Also, if you know of anyone else who may benefit from the contents of this video, please consider doing that person a favor and sharing the video with them. Until next time, I'm Andrew May, investment advisor and certified financial planner professional, and I believe that if you can avoid the 3 mistakes investors make during election years, then you will be better prepared to do this.